Have you ever tried an indicator-based strategy that you stumbled upon in a viral post, only to find yourself losing trades consistently? Don't worry, you're not alone. In this video, I'm here to shed a light on just how misleading these headlines can be. As a beginner trader, it's easy to fall into the trap of relying solely on indicators, hoping for a quick shortcut to success, as those who called mentors promised. However, I'll show you how to overcome these hurdles and view the markets through the lens of a professional trader. Let's dive in and discover the right way to approach trading for sustainable success. Indicators were first introduced in the world of trading in the early 20th century, notably around the 1920s. One of the pioneering figures in this field was John Wells Wilder Jr., who developed popular indicators such as the Relative Strength Index, RSI, and the Average True Range, ATR, during the 1970s. These indicators gained widespread adoption due to their ability to provide traders with valuable insights into market dynamics and trends. During their inception, indicators enjoyed significant success for several reasons. Firstly, they offered traders a structured and systematic approach to analyzing price data, allowing for more informed trading decisions. Additionally, indicators provided a way to quantify market sentiment and momentum, helping traders identify potential entry and exit points with greater precision. However, over time, indicators began to lose their precision and effectiveness for several reasons. One of the primary reasons is the evolving nature of financial markets. As markets become more complex and interconnected, traditional indicator-based strategies may struggle to adapt to changing market conditions. Additionally, the proliferation of algorithmic trading and high-frequency trading has led to increased market noise and volatility, which can distort indicator signals and lead to false signals. Furthermore, indicators inherently suffer from lagging effects. Most indicators are based on historical price data, meaning they react to past price movements rather than predicting future ones. This lag can result in delayed signals, causing traders to enter or exit positions too late and miss out on potential profits. In fast-moving markets, this lag can be particularly detrimental, as traders may find themselves chasing price action rather than anticipating it. Overall, while indicators have played a significant role in the evolution of trading strategies, their effectiveness has diminished over time due to changing market dynamics and inherent limitations. As a result, traders like to adopt a more holistic approach to trading that incorporates multiple sources of information, including fundamental analysis, price action, and market sentiment, to navigate today's dynamic markets successfully. In this lecture, we'll investigate the downtrend on the euro as a prime example of how indicators can generate false signals that traders can avoid. Our focus will be on the 4-hour chart, as it's the most suitable time frame for evaluating the trend's health. Unlike lower time frames that may yield erratic price movements, or higher ones that require days to weeks to confirm trend changes, the 4-hour chart strikes a balance. It allows for the formation or breaking of intermediate-term highs or lows intraweek, providing a clearer picture of trend dynamics. Here on the first screen, just before the downtrend begins, something important happens. The price shoots up and closes above the 50-period moving average. While traders who rely solely on indicators were expecting the uptrend to continue after a retest, those following ICT concepts were paying attention to something different. They were waiting for the price to form the high of the quarter. Once it broke above this monthly high, confirming the start of a bearish trend, they knew it was time to act. This shows how precise ICT concepts can be. They're not just about predicting daily or weekly highs, but even the highs of the quarter. On the second screen, we see another interesting move. The price breaks above the moving average line, but quickly turns bearish on the same day. This price action was influenced by a high-impact news event, which is the CPI release. Additionally, the price was approaching a weekly bearish fair value gap. I recall taking a short trade at this area, and it turned out to be profitable. This shows how news events and important levels in the charts can come together, giving traders good chances to make profitable trades if they're ready and paying attention. On the third screen, we see another interesting move. The price breaks and closes above the 50-period moving average, but then in the following days, it turns around and starts moving lower. This happened during a week when there was a high-impact news report called the non-farm payroll release. According to ICT concepts, NFP can really change how prices behave for the whole week. During this time, the price was following a pattern called the turtle soup. It's when price goes up first to trigger buy stops, but then reverses and continue going down. This shows that even during a risky week like NFP week, traders who know what they're doing can still make good decisions because they follow certain rules and guidelines. Imagine if we just followed these false breakouts blindly, relying only on indicators. It's likely we would have lost all our profits, or even worse, blown our trading account easily. On the fourth screen, we encountered another scenario where the price broke above the 50-period moving average. However, well-informed traders didn't rush into making trades based solely on this signal. Instead, they exercised patience and waited for the price to reach a specific point on the chart called the rejection block premium array before considering a continuation entry. In our exploration, we have seen some examples showing how relying solely on indicator-based strategies isn't as promising as they make it sound. And if we were to dive into lower time frames, such as the 15-minute or 5-minute charts, we'd find even more examples of false signals. It's a shame that some folks still push these strategies, promising newcomers easy money. They'll pick any random currency pair, like Aussie CAD, and claim that just by peeking at a 15-minute chart with a few indicators, you will become rich quick. But trust me, I've been there too, sifting through heaps of false information to get where I am today. And let me tell you, that's not how trading works. Even with ICT concepts, if you try to apply them directly to a 5-minute chart, success isn't guaranteed. That leads us to a question. If indicators are considered outdated, why do some traders still use them and manage to be profitable? Well, by what I know, there are a couple of reasons. First, these traders are exceptionally skilled at managing their money. Even if they encounter a false signal from an indicator, they are careful enough not to lose a significant portion of their funds. Second, they prioritize analyzing higher timeframe structures. They understand that focusing on lower timeframes, like the 15-minute chart, can lead to more false signals and higher exposure to losses. By focusing on higher timeframes, they have fewer setups to execute on. But these setups are often more reliable and less risky. As a beginner trader, you might be asking yourself, should I focus on studying ICT concepts or indicator-based technical analysis? Well, if you ask me, I'm a bit biased. I'll always root for ICT concepts. Here's my take on it. If you're currently seeing success with indicators, I encourage you to explore ICT concepts for a few months. It could give you valuable insights into how markets truly operate. Now, if you're a beginner and still not convinced and want to stick with indicators, I'd advise you to prioritize working on the higher time frames, because that's where the big money is, and it's where hedge funds make their entries. Additionally, it's crucial to have a strict money management plan in place to protect your capital and minimize losses. So, whether you choose ICT or indicators, remember to prioritize higher time frames and implement a solid money management strategy. By reaching this point, we've successfully covered key insights in this lesson, exploring various examples to illustrate our points. Whether you're considering ICT concepts or leaning towards indicator-based strategies, I hope you've gained valuable insights to guide your trading journey. I'd love to hear your thoughts. Feel free to share your opinions and experiences in the comments below. Remember, trading involves significant risk and is not suitable for all investors. Before engaging in any trading activity, it's crucial to carefully consider your investment objectives, level of experience, and risk tolerance. Past performance is not indicative of future results. Any strategies or methods discussed are for educational purposes only and should not be construed as financial advice. Don't forget to give this video a thumbs up if you found it helpful, and consider subscribing to stay updated with more insightful content. Until next time, happy studying and stay safe.